Hey everyone, and welcome back to the channel. Today, we're diving deep into a specific stock that has triggered our hard-to-borrow screener, showing some truly remarkable metrics. We're talking about HCWB Biologics Inc., ticker symbol HCWB. We'll break down exactly why this stock is drawing attention in the world of short interest and potential squeeze plays. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/info card. Let's get straight to it. HCWB Biologics Inc., or HCWB, is a clinical stage biopharmaceutical company operating in the healthcare and biotechnology sector. They're focused on discovering and developing novel immunotherapies for chronic, low-grade inflammation and various diseases. Their lead products, HCWB-18 and HCWB-40, are at the forefront of their pipeline. This is a microcap company currently sitting with a market capitalization of just $6.09 million. What is cost to borrow and why it matters? Before we get into HCWB's specific numbers, let's quickly explain what cost to borrow actually means. When a short seller wants to bet against a stock, they first have to borrow shares from a broker. They then sell those borrowed shares hoping to buy them back later at a lower price and return them to the lender, profiting from the difference. But borrowing shares isn't free. The cost to borrow is the annualized interest rate short sellers pay to hold onto those borrowed shares. When this fee gets extremely high, it signals that demand to short the stock is strong, but the supply of shares available to lend is very, very low. A high cost to borrow means it's expensive to stay short, putting pressure on short sellers. Why this stock is hard to borrow right now. Show chart with CTB fee and momentum. Now, let's look at HCWB's incredible numbers that made it flash on our radar. The current cost to borrow fee for HCWB is a staggering 679.4% annualized. Think about that, nearly 680% interest per year just to hold a short position. What's even more significant is the momentum behind this fee. It surged by plus 122 percentage points over just the last 5 trading days. This indicates a rapid increase in the cost of borrowing. Adding to this pressure, there are only about 95,000 shares currently available to borrow against an estimated float of 1.6 million shares. That's a very tight supply relative to the float. Our internal composite squeeze score for HCWB currently stands at 57.1 out of 100, which suggests a notable, though not extreme, potential for volatility given these metrics. Squeeze mechanics explained. So, what happens when a stock becomes hard to borrow with such high fees? This is where short squeeze mechanics come into play. When the cost to borrow is this high, and the supply of shares to short dries up, short sellers can find themselves in a bind. If the stock price starts to rise, even slightly, the short sellers face two pressures: their short position is losing money, and they're paying exorbitant fees just to hold that losing position. This combination can force them to start buying back shares to cover their short positions and minimize losses. This forced buying creates upward price momentum, which can in turn trigger more short sellers to cover, creating a cascading effect known as a short squeeze. It's a vicious cycle for shorts, but it can be lucrative for long investors if it materializes. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also mean short sellers have very strong conviction and are willing to pay high fees because they believe the stock will ultimately go lower. Dilution risk check. Show SEC filing screenshot no recent dilution. One of the biggest risks to any potential short squeeze is dilution. Dilution occurs when a company issues new shares, increasing the total share count and often lowering the value of existing shares. This can negate any upward momentum from a squeeze, as new shares provide more supply for short sellers to borrow or for the market to absorb. For HCWB, our check for dilutive SEC filings like -1s, -3s, or 424 BS over the last 90 days found no recent activity. This is a positive sign for a short squeeze thesis, as it suggests the company isn't currently adding significant new shares to the market that could offset price appreciation. Recent reverse split watch. Show calendar with reverse split date. Now, this is a very important point for HCWB. The company executed a 1-for-6 reverse stock split just 15 days ago, on June 30, 2026. A reverse split reduces the number of outstanding shares and proportionally increases the price per share. For example, if you had 6 shares at $1 each, after a 1-for-6 reverse split, you'd have 1 share at $6. This effectively reduces the total float, which can make a stock even more prone to volatility. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market digests the new share structure and resets expectations. While this is a common pattern we've observed, especially in thinly traded names, it's absolutely not a guarantee for HCWB. Again, I must reiterate. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Joe Price chart. Let's look at the recent price action and volume for HCWB. Today, the stock is down -4.44%. Over the last 5 days, it's fallen -7.43%, and over the last 30 days, it's seen a significant drop of -59.96%. Volume has been quite low. Today's volume was only 42,200 shares, which is well below its 30-day average of 137,495 shares. In fact, today's relative volume is just 0.3x its average. This low liquidity means that any significant buying pressure could have an outsized impact on the price, especially with such a tight float. To see a potential short squeeze develop, we'd want to watch for a sustained increase in buying volume and positive price momentum that forces those short sellers paying 679.4% to cover. The combination of the extremely high cost to borrow, the low available shares, the recent reverse split, and the lack of immediate dilution risk paints an interesting picture for HCWB. HCWB Biologics Inc. HCWB certainly presents a fascinating case study, with its astronomical cost to borrow, extremely limited share availability, and recent reverse split. Keep these factors in mind as you conduct your own due diligence. This is a volatile space, and understanding these mechanics is key. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth stock analysis, and let us know in the comments which hard to borrow stock you'd like us to cover next. Thanks for watching, and we'll see you in the next video.